At the heart of the global monetary system lies a pact few people even know about, yet it reshaped how money, gold, and power move across the world. A handful of central bankers met in secret, stepped outside the glare of public scrutiny, and made a decision whose ripple effects we still feel today. They didn't just change how banks behave, they changed the rules of the game. Before we go further, tell me in the comments where in the world you were watching this from. Now, let us peel back the curtain and uncover the secret pact that altered the world economy forever. In a world dominated by invisible wires of finance, the most powerful agreements often happen behind closed doors. We're taught about treaties, trade deals, and wars, but what about the quiet pacts that steer the flow of gold, currencies, and central bank reserves? This story begins with one such pact. Signed in Washington in 1999, the Washington Agreement on Gold, also known as the first central bank gold agreement. It involved major central banks pledging that gold will remain an important element of global monetary reserves and limiting the amount of gold they could collectively sell. On the surface, a technical, niche agreement about gold. Beneath the surface, a shockwave that shifted trust in currencies, global reserve assets, and monetary power structures. To understand why this pact mattered, we must go back a little farther. In the decades following World War II, the global economic order was anchored by the Bretton Woods Agreement 1944, which pegged major currencies to the US dollar and the dollar to gold at $35 per ounce. That system began unraveling when the US found itself printing more dollars than it had gold to back it, culminating in the Nixon shock of 1971 when the dollar was unlinked from gold. After that, currencies floated, central banks gained power, and gold's role changed but never disappeared. By the late 1990s, global central banks held massive gold stocks. Today, they collectively hold more than 35,000 metric tons. Meanwhile, gold had become both a symbol and instrument of monetary power. When a group of European central banks announced large gold sales in 1999, including the UK's decision to auction half its reserves, it spooked the market. The response, the Washington Agreement on Gold. It was less about gold per se and more about signaling. Central banks will no longer operate in silence, they will coordinate. And that coordination shifted power. Here's what the pact did. It declared that gold will remain an important element of global monetary reserves. World Gold Council. It placed a cap on official gold sales. In the first iteration, no more than 2,000 tons over 5 years, around 400 tons per year, among signatories. It limited the use of gold lending, leasing, and derivatives by the participating banks. World Gold Council. Why did this matter? Because previous massive gold sales by central banks had destabilized the market, undermined confidence in gold as a reserve, and thus threatened the currency reserve equilibrium. The pact created transparency and coordination, things central banks rarely offer in public. It sent a message to markets. The official sector is acting together, and intentions are no longer hidden. That matters because when central banks act, markets react. The effects of this pact were far-reaching. Reserve asset shift. Gold had been gradually de-emphasized as fiat currencies and bonds dominated. The pact helped reverse that trend. Central banks reaffirmed gold's importance. Credibility and trust. For central banks to coordinate, especially on something as symbolically charged as gold, boosted their collective credibility, and by extension, the trust in the global monetary system. Signaling of monetary power. When central banks produce an agreement, it's a display of collective power. The US dollar, the euro, reserve currencies, all these frameworks depend on trust and coordination. A pact among central banks strengthened that architecture. Market stability. By limiting sales, the pact prevented a flood of gold entering the market that could send shockwaves through currency and reserve markets. The article by Philip Klapwyk shows the significant stabilizing effect. Set the stage for future reserve strategies. The pact became a framework that allowed central banks in emerging markets to view gold not just as a relic, but as a strategic reserve asset in its own right. Investing News Network, In short, a niche agreement about gold had become a cornerstone of modern global reserve management. By the time of the 2008 financial crisis, and in the years following, central banks had gained enormous influence through quantitative easing, foreign reserve management, and emergency lending. A 2024 study shows that the formal independence of central banks across 155 countries has increased dramatically since the 1990s, even though political pressure remains. CEPR. At the same time, gold became a hedge not just against inflation, but against currency, reserve, and geopolitical risk. In 2024 to 25, central banks were net buyers of gold, restoring its importance in the reserve mix. So the 1999 Pact didn't just fix a gold sales issue, it laid the foundation for a world where central banks coordinate, where reserves are diversified, and where gold returns as a strategic asset. The decision of the UK Treasury to announce major gold sales in 1999 triggered market panic. Prices plunged, speculation surged, and that directly led to the Pact. In 1999, central banks controlled about 45% of global gold reserves, so their actions mattered enormously. World Gold Council post-Pact. Gold sales by signatories dropped significantly, aiding price stability and reserve confidence. That restraint allowed central banks to navigate gold markets more confidently, and the world noticed. Fast forward to today. Gold is once again among the top reserve assets globally, often second only to the US dollar in significance. See latest reports for 2024 to 25. Emerging market central banks are actively accumulating gold, partly in response to concerns about US dollar dominance, inflation, and geopolitical risk. The Pact created a precedent: reserve asset coordination, transparency in central bank intentions, and collective signaling of monetary power. The relationship between central banks, gold, reserve currencies, and global financial stability is fundamentally altered because the 1999 Pact showed that even old assets like gold can be part of new monetary strategy. When the Washington Agreement on Gold was quietly signed in September 1999, only a handful of insiders understood what it truly meant. Most saw it as a technical coordination between central banks. But in reality, it marked the rebirth of central bank cooperation and set the blueprint for how money, power, and trust would function in the 21st century. Because what began as a promise to control gold sales eventually became the foundation of modern central bank diplomacy. The 1999 Pact didn't end there. It was renewed 5 times, in 2004, 2009, 2014, and 2019, each time reinforcing central bank unity. The message was consistent. We will act together. We will not compete against each other in the gold market. That cooperation built trust between central banks across continents, from the European Central Bank, ECB, to the Swiss National Bank, from the Bank of England to the IMF. And that trust became the silent backbone of the global economy, especially during crises. When the 2008 financial crash hit, it was the central banks that stepped in, cutting rates, printing money, and swapping liquidity across borders. Behind the headlines, those emergency swap lines between the Federal Reserve, ECB, and Bank of Japan were only possible because the foundations of cooperation had already been laid years earlier, by agreements like the 1999 Gold Pact. In other words, the secret gold deal had grown into something far more powerful, a global alliance of central banks managing the world's financial bloodstream together. After 2008, the focus shifted from gold to liquidity, the lifeblood of modern finance. The same pattern repeated. When one market panicked, others followed. So, central banks began coordinating interventions, synchronizing rate cuts, bailout programs, and quantitative easing, QE. Between 2009 and 2022, the Federal Reserve, European Central Bank, and Bank of Japan collectively injected over $25 trillion into the global economy through QE programs. That unprecedented coordination prevented another Great Depression. but it also tied the world's financial systems together in a web of dependence. When the Fed raises rates now, currencies tremble from Istanbul to Jakarta. When Japan intervenes to protect the yen, capital flows ripple across London, New York, and Singapore. This is the direct legacy of central bank coordination, born in quiet agreements like that 1999 Pact. But here's the twist. In the 2020s, gold came roaring back. After years of low inflation and easy money, the post-COVID surge in prices, supply shocks, and geopolitical tensions revived gold's ancient role as a trust anchor. According to the World Gold Council's 2025 data, central banks purchased over 1,037 tons of gold in 2023, the highest level in modern history. The People's Bank of China, Reserve Bank of India, Central Bank of Turkey, and Poland's National Bank led the buying spree. Their reason? This marks a quiet revolution, a return to tangible value in a world flooded with digital debt. And it's directly connected to the 1999 Pact, which preserved gold's legitimacy as a reserve asset. If that pact had never existed, gold might have been abandoned decades ago. Instead, it's back, stronger, strategic, and symbolic. So, what does this mean for the US dollar? For over 80 years, the dollar has been the backbone of global trade, reserves, and oil pricing. But as central banks accumulate gold and diversify reserves, the dollar's share is quietly shrinking. According to IMF data, Q2 2025, the dollar now makes up 57% of global foreign reserves, down from 72% 2 decades ago. Gold, the euro, and even the Chinese yuan are slowly taking a larger slice. This shift doesn't mean the dollar will collapse, but it does mean the world is preparing for a post-dollar era, just in case. And that's exactly what the 1999 Pact symbolized: monetary insurance, a coordinated safety net for when fiat trust fades. Here's the part most people never realize. Central banks, by design, are independent. They don't answer to voters. They don't stand for election. Yet they hold the power to create or destroy trillions overnight. The Washington Agreement and its successors created an informal club of central banks, an unelected transnational layer of power. This club meets regularly at places like Basel, Switzerland, inside the Bank for International Settlements, BIS, sometimes called the Central Bank of Central Banks. It's there that policies are discussed long before politicians hear about them. Interest rate corridors, swap lines, digital currency pilots, all coordinated quietly, long before they reach headlines. It's not a conspiracy. It's cooperation born of necessity. But it means that global monetary policy is now shaped less by parliaments and more by consensus among unelected bankers. A system that began with gold sales has evolved into the governing fabric of global capitalism. Now, as we move deeper into the 2020s, central banks are entering another coordinated phase, the digital currency era. Over 130 countries, representing 98% of global GDP, are now exploring or developing CBDCs, IMF 2025. The European Central Bank is piloting the digital euro. China's ECNY already processes millions of transactions daily. The U.S. Federal Reserve is quietly testing wholesale digital dollar frameworks, and the BIS is coordinating multi-country CBDC experiments like Project M-Bridge, linking central banks in Asia and the Middle East. This isn't coincidence. It's the continuation of the same cooperation that began with the 1999 Pact. Back then, central banks controlled gold. Today, they're preparing to control data, liquidity, and digital value in real time. For everyday people, this hidden world may seem distant, but its effects are everywhere. When central banks act together, interest rates, mortgages, and savings are affected instantly. Their decisions shape the value of your currency, your job prospects, and even the price of your groceries. When they buy gold, it signals fear. When they print money, it signals control. The next time you hear about a policy coordination meeting at the BIS or IMF, remember, this network began not with a war or a treaty, but with a quiet agreement about gold. An agreement that rewired how the modern world handles money, debt, and trust. The lesson of this story isn't about gold or dollars. It's about trust. Because money is only as strong as the system behind it. In 1999, central banks realized that the biggest threat wasn't inflation or deflation. It was chaos. And by choosing coordination over competition, they stabilized a fragile global order. But stability comes at a price: dependence. Every economy, every market, every person now lives in a system so interconnected that one misstep, one unexpected rate decision, can shake the world. That's the power of the Pact, a secret agreement that still governs your reality. So what do you think? Did central banks save the world, or quietly take control of it? Let me know your thoughts in the comments, and don't forget to tell me where you're watching from. Because this story, like money itself, connects us all.